As I said, today we will start partnership. In your CA Inter, there is only dissolution and piecemeal. Earlier, admission, retirement, there, everything was there. But now it is not there because it has been pushed to foundation level. But that doesn't mean that they will not ask these questions or the fundamentals of it will not be known. That's why I'm going to basic some part of it. I'm going to cover this, and then we'll be going to this because these are not that what is it called? A little tricky, but at the same time, sometimes it's simple, much simpler than what we can do. So the number of problems I normally used to do for these things, I'm not going to do. But yet, I want you to get a idea about this so that you never know they can. You cannot say, sir, it is not there in the syllabus. It is there. As long as it is in foundation, it is in inter also. That's the understanding with which you have to go because they expect that you should have known it. Okay. With that idea, I'm just going to try and explain. A and B are partners with profit sharing ratio. These are hypothetical cases. In the partnership, there is a building, right, which they purchased for cost was in the books book value. There is no depreciation. Assume there is no depreciation. Cost 30,000. The market value today is 40,000. Market. Now that is market value on say today is what day 16/9. On 16/9, C is admitted as a partner. Now, when C is admitted as a partner, he is coming in. Now, when he comes in, and for now the profit sharing ratio is 5:3:2, the ratio in which it has been now divided. It is in which it is being divided. Now, the next day on the 17th, C is saying he is asking for dissolution. So, hypothetical case is to understand the concept. C is asking for dissolution. When C is asking for dissolution, naturally this building has to be sold and monies have to be brought in. When you sell that, how much you are going to get? 40,000. And book value is 30,000. So you make an extra profit of 10,000. Now because C is also there, this will be divided amongst A, B, C in the ratio of 5:3:2. Therefore, he will get 5,000. C 3,000. 2 is. Now, do you think it is right? Do you think by normal application of mind, is there any problem if it happens? Maria?
So C has only been in the business for a day. I don't think he deserves 2,000.
Exactly. And same way, A and B have been there. They have only contributed. They should be getting the benefit of the increase from this 30,000 to 40,000. Therefore, this doesn't seem to be right. Then how do we correct it? That is the idea. You understand, Venus? Have you understood?
Yes, sir.
That means if you do like this, there is some problem. As a result, A and B will lose, C will gain. Aparna, are you clear?
Yes, sir.
Now we have to still find a way how this can be rectified. So I'm going to now again go back to the time before C is admitted. Just see. Before C comes in, what I am going to do is I am going to increase the value of the asset to 40,000. Therefore, this building account or premises account, whatever is the name, debit 10,000 to A's capital to B's capital in their existing profit sharing ratio, which is now how much income? 6,000 and 4,000. 10,000 income. Now, this is on the 15th, before the day he coming. That is on the 16th morning, whatever day, 16th. Now C joins, right? And the ratio of 5 is to 3 is to 2. Now, next day on the 17th, he is asking for dissolution. Now, what happens when dissolution happens? This asset will be sold. How much you will get? 40,000. What is the? This is the market value. What is the book value? Aparna, what is the book value? When you sell on the 17th, what is the book value? Maria, what is the book value?
40,000.
40,000. It is not 30 because it has been increased to by 10,000. Therefore, your benefit or extra figure is nil. So therefore, C will not benefit, nor A and B will be losing. Nor A and B will be losing. Is it clear? Same logic applies. Suppose there is a liability. Suppose let us imagine a liability. It's an asset, right? Let us imagine a liability. Suppose it is the provision, some liability. It is 30,000, should have been 40,000, right? In that case, what will happen? If it is not done, C will lose because he will be debited to that extent when it comes in. So again, I will erase this, assuming that we don't do anything and there is a dissolution. Suppose A and B are asking for dissolution. A and B are asking for dissolution. Therefore, on that day, nothing is done. It is at 30,000 only. Therefore, this liability has to be paid, or provision or liability has to be paid. Then what do you do? That liability account, you have to debit 40,000 to A, B, C. Sorry, not like that. So liability has to be paid, right? So liability account, debit 40,000 to bank 40,000. But the liability account was having only a balance of 30,000. Now you have paid 40,000. Therefore, you have to extra credit 10,000. But then where will you debit? You will have to debit A, B, C. A debit, A capital debit 5,000. B capital debit 3,000. B capital debit 2,000. To liability account 10,000. Venus, is there a problem if this happens? What is the problem?
C is not liable.
C
for
is
2000.
not, C is going to lose that 2000, which is not right. C is, the fact that C has to get the debit for that is not right because he was not part of the liability. This has happened prior to his coming. Therefore, he should not be held responsible for the 2000. So what we, have you understood? Aparna, have you understood? Maria, have you understood? Therefore,
Yes.
Maria, have you understood? So it is not that assets only, it can be liability also. Is it clear? Now, try to understand that it can, therefore, what is to be done? What is to be done is, before any change in the, now let us look at another situation. A and B and C, A, B and C are partners in the ratio. Don't worry about writing, I will give you notes. 5:3:2. This is not, and again, there is a premises or building. Book value is 30,000. Market value is 40,000. On 16/9. On 16/9, C is retiring, and whatever is a capital account in his, nothing is considered about it. Whatever is a capital account is paid to him, and he is went. He doesn't know, understand the complication of partnership. The moment he retires, A and B, what they do, they will sell that building, right? And they will get cash account debit, 40,000. To building, 40,000. Now, if you look at the building account, who is doing now? He is gone. Nothing is done after that. This is on the 17th. Building account was having a balance of 30,000. But you got money 40,000 by bank. Therefore, there is an extra amount of 10,000. Now, who are the partners? Aparna, now who are the partners when the building is being sold? A and B. And they are sharing ratio in the 2:2. So what they will do, the 10,000 amount, they will share into their thing. They will say building account debit 10,000 to A's capital 6,000 to B's capital 2,000. Venus, is this right?
No, sir.
No. Who is losing?
C.
C. Therefore, even if it is admission or retirement, if the book value of the assets are not equal to the market value, whether it is admission, retirement, death, somebody is going to lose. Therefore, we have to take care of that. How do we do it? Something. So we are now going to look at, what I just wanted to tell you, that this is in terms of the only in relation to, not only in relation to admission, it is in relation to retirement also. In retaining death also, it's same thing, like retirement will come. Now we'll go back and see how to handle it when it is an admission problem. So admission, so therefore I'm going to make a statement here. Please understand problem. Once you understand, you can recollect anytime. So what we need to understand is that whenever there is a change in partnership, equities are disturbed and hence should be corrected before such change. This is the basic statement, so you can understand what I'm saying. So we have to do something. Now, what do we do? You are telling all this, but what do we do? Let us understand what we are doing. In the case of admission, I'm not going to go to retirement now. In the case of admission, let us see what we are going to do. Now, A and B, these two, building value 30,000, market value 40,000. Now, before C comes, if we are, as we saw, we are debiting that to A's capital, to B's capital, 10,000. Sorry, I'll just write a little on the left side so that you understand. Before C is coming, building debit 10,000 to A's capital 6,000 to B's capital 4,000. Okay, I'm talking of building. After C comes in, so after C comes, no entry, nothing. So what has happened? This has become 40,000, and everything has been market like building liability. Everything has been done. So so now it is a level playing field. Anybody can come, anybody can go, no problem. Even if it is a retirement, there is no problem. So once we have raised all the assets and liabilities to their market value, anything can happen, no problem. Nobody will get affected. That's the logic. Now C comes in, we leave it as it is. So building will remain in the market value. That is method number 1. That is option 1. What is option 2? What is option 2? Same as this. That is, we will pass building debit 10,000 to A's capital 6,000 to B's capital. Now, mind you, when I am writing building, it is not only building. It can be any other asset. It can be any other liability also. It will be reversed. Same similar entry. This is option number 2. Now C comes in. But after C comes in, between all of them, they say, no, we will not maintain the building at the market value. We will take it back to book value. Therefore, now C has come in. So now, this has to be, building has to be again restored back to 10,000. That means we have credited. We debited here. Now we are crediting it. Therefore, now C has come into the partnership. Therefore, A's capital debit. Now C has come. In what ratio? 5:3:2. Therefore, you have to 5. B's capital 1000. C's capital 2000. Because C has come. Now you can say, sir, why he is getting debited now? Is it fair? Yes, it is fair because later on, when suppose they sell the property, 2000 will get credited, therefore it will nullify. He will not get any benefit later on. Now, next option is the last option is don't raise any, no entry, but just pass a net entry of this. You look at it, this gets nullified, right? So because they are not, they are saying, no, sir, we don't want anybody to know our asset value in the books. When we write an entry, somebody outsider will know that see, this is the value of the asset. This is the value of the asset. We don't want anybody to know, but we want to do the adjustment. Therefore, we will not pass the entry in the books, but we do an internal entry. What is the internal entry? Take the net. Therefore, here what will happen? See, if you take the net, building gets cancelled, then A's capital is net credit. B's capital, there is net credit 1000. C's capital is debit. Therefore, the net entry will C's capital account debit 2000 to A's capital 1000. 1000 to B's capital 1000. So that means without doing anything, all this problem has been resolved by just passing a net entry C's capital account debit to A's 2000 to A's capital 1000 to B's capital 1000. Once we do that, this is done. Is it clear? This is what I wanted to tell you. So I'll just save this in case you want, I can message it. This understanding is something which is very, very clear. Now, always understand that if you are not able to, any of them can be done depending on the problem. What they are saying in the problem, we have to do. Now, what applies for building applies for all the other assets or other liabilities also. That we see as we do the problem. Okay. So this is it for the time being. I'm not telling more. Retirement also similarly we are told that when we do the problem, couple of problems, then we will do retirement. Couple of problems so that you understand how to handle. Okay. Now let us go to problem. Now, how to handle the problem is something which I need to share with you.